it is very important to distinguish between risk analysis and prediction. In much of this course, we design strategies for tactical asset allocation, and this involves forecasting asset returns. In the regression analysis that we perform, returns from particular asset classes or countries at time t are regressed on lagged information variables that are available at t minus 1. This is a predictive regression. The variables that we use in these regressions are variables that have economic meaning. However, there's no particular economic theory that tells us which variables must go into a predictive regression. The predictive regression is really a way to define the conditional expectation of the return for the asset class or for country. It's a statistical model, and almost by definition, it's got very low explanatory power. So the amount of variance that we explain, or the R squared, is in the range of 2 to perhaps 10%, far lower than what we're used to achieving in a usual regression. Now, risk models are different. The goal of the risk model is to explain returns based upon information that's contemporaneously available. So the return in time period t is explained with a global risk factor that's also available at time t. So there's two distinguishing characteristics. First, this is explanatory. It explains the returns ex post. We explain the returns in January with variables that are realized in January. This is in contrast to the prediction regression, where we try to forecast January's return based upon information available in December. The second distinguishing feature of the risk model is that the variables that we use are common. The risk factors are global. So for every asset class, or country, we use common risk factors, all available at time t. Each country or asset class will have its own risk exposure, or risk sensitivity, or risk loading, or beta. All four things mean the same thing. They mean the slope coefficient that is country or asset class specific that is applied to the global risk factor. These explanatory regressions capture a substantial amount of the variation in the returns. So instead of talking 2 to perhaps 10% in a predictive regression, the explanatory regression could have up to 95% predictive power to explain the returns. Now, there's a question as to how to use these risk regressions. And there are basically three uses. Use number one is a matter of risk control. By knowing the risk loadings of each asset class, we're able to determine what sort of risk exposure we're taking for a portfolio as a whole. There's one thing to invest in a portfolio, another thing to realize what sort of risk exposure that you're taking on. So the risk analysis, by looking at the betas, we're able to figure out what the portfolio betas are against various different global risk factors and understand better the sorts of risks that we face going forward. The second and third way that these risk models are used is more in terms of a portfolio strategy. Now remember that these explain what happens in terms of returns. So it seems odd at first to think about how to combine these into a portfolio trading strategy. And let me try to explain. Suppose that there's only one source of risk, and that's the change in the oil price, a simplified example. And suppose that we know that Japan is very sensitive to changes in the oil price. And the sensitivity is negative, and suppose it's -1, which means that on average, if oil prices go down by 10%, then the Japanese stock market should also go down by 10%. Suppose it's the case that we know that the risk loading is -1, and we actually see oil price go down by 10%. The price goes down, that means there should be favorable news for Japan. But suppose the Japanese market responds, and say this all happens in January, and increases by only 5%. Then potentially we could use this model to say, well, the model suggested that on average at least, the equity price should have increased by 10%. However, we only see 5% increase. Therefore, we might expect further increases in the future. As a result of this, you would purchase or go long Japanese equities. So it's possible to actually use the explanatory model to get a sense of where the asset should be. When we observe the actual place that it is, we can take a look at the difference between what's observed and what we think should hold true according to the explanatory model. So that's the first way that these risk models are used in portfolio management. The second way is a little more subtle. We've got many different asset classes and countries that are being influenced by a common set of global factors. And each asset class and country has got its own exposure to these global factors. Well, some people might actually say, well, instead of trying to forecast all of these individual asset classes and country returns, let's just forecast the fundamental global factors. With forecasts of the factors, then by applying the betas, I can figure out what the forecasts of the returns are for all of these asset classes and countries. So instead of forecasting potentially hundreds of asset classes and countries, you forecast maybe 5 or 6 factors. Now, this is kind of an indirect way of doing forecasting. And often what happens is that these factors are difficult to forecast. But you might have an expertise in forecasting maybe 1 or 2 of them. And suppose it's 1. So you've got a very good model for forecasting one particular asset risk factor. So what you can look at is if you're forecasting that risk factor to increase, you can tilt your portfolio to have a lot of exposure to that particular factor. So in the example for oil prices, suppose that you've got a very good model, and your model predicts that the price of oil is going to drop. And you know that Japan has got a high sensitivity to the oil price change. So you're going to tilt your portfolio towards countries like Japan that have a high sensitivity to oil price movements. This second strategy is called a factor tilting management approach. The first strategy that I described is often referred to as an alpha strategy or residual strategy. The common thing in both of these models is that they use explanatory regressions, time t against time t, in a set of global factors in order to implement a portfolio strategy on an ongoing basis.